BDCs, also known as business development companies, are an incredibly unique asset class that can often generate high double-digit yields. We're talking about 10% plus. And in fact, this is also an asset class that over the last 5 years was outperforming the S&P 500 by a wide margin until we saw the sell-off in the last few months. And this BDC sell-off is something I stated a few months ago on Dividendology.com that I thought was likely to happen. And I'll tell you why I thought this was likely to happen just a little bit later in the video, but spoiler alert, it has to do with interest rates. Now, the good news is I believe this sell-off is creating opportunities. For example, if we look at BIZD, this is an ETF that holds multiple business development companies. And we can see in the last year, it's now down by almost 13%, and year to date, down by almost 15%. Many of the popular BDCs that you're familiar with, such as Main Street Capital and Ares Capital, are trading at much better valuations than they were at the beginning of this year. So where are the opportunities to buy these high-yielding assets? Our goal in this video is to find the best BDCs, the ones that are positioned to be able to continue to grow their fundamentals and maintain their large dividend payments during this falling rate environment. And to be completely transparent, there is a lot of bad BDCs out there. And to be even more transparent, most softwares don't provide the critical data and information you need to actually analyze these BDCs. This was something I realized a couple of years ago. And so at the beginning of this year, over on Dividendology.com, I started working on the Dividendology database. This is something that I update every single month. I have a database for covered call ETFs, super investors, REITs, BDCs, and I'll be adding more assets later. And today I'm actually going to be sharing the BDC database with you in this video. But again, if you want to get access to all these databases and the updates that come along with them in the future databases, be sure to check out Dividendology.com at the link in the description, or you can simply scan the QR code that I'm putting on the screen right now. Now, if we're going to properly analyze these assets and find the best opportunities to buy these high yielders, we need to know how to analyze them. So let's quickly touch on a few key metrics we have to understand about BDCs. Now, we have to understand BDCs provide loans to small and mid-sized businesses that can't always access traditional bank financing. And in return, those businesses typically pay interest at above average rates. So interest is collected minus expenses flows into net investment income. This is a key metric. But here's what we have to make note of. Most of the loans given out by BDCs are floating rate loans. So when interest rates are rising, the loan yields increase, which will boost the net investment income, So when rates fall, the loan yield drops, which means net investment income will be falling. Now, we have to remember, dividends are paid out of net investment income, and we'll get to that in a moment. So what type of rate environment are we operating in right now? Well, we've already seen 2 interest rates just in the last few months. And from what we're seeing at the time of this recording, there's about a 51.6% chance we see another interest rate cut on December 10th. So what this means is BDCs with a high degree of variable rate loans will probably be seeing net investment income drop in the future. So right now in the Dividendology database for BDCs, we have about 42 different BDCs listed. It takes a long time to conglomerate all this data every single month. But if we zoom in and scroll over, we can see right here the variable rate debt. What percentage of their loans are given out at variable rates? For a lot of BDCs, this is extremely high, 99, 99, 98%. The vast majority are about 95% or above. So one of the things we want to do is filter out BDCs that have a lot of exposure to the risk of rates continuing to decrease. And here's what's also so interesting about this. If we use Main Street Capital as an example, one of the most popular BDCs, we can see during 2020, 2021, when rates essentially went to zero, they didn't pay out any special dividends. Why? Because net investment income was dropping with low rates. But as rates went quite a bit higher in the following years, we can see this in 2023, we can see they started paying out a lot in special dividends. Why? Because net investment income grew considerably during this time. So variable rate is something we'll want to filter by here in just a moment. But let's talk about our other key metric, tangible book value per share. If we zoom back into our database, we can see we have metrics for our 3, 5, and 9-year tangible book value per share compounded annual growth rates. So what is this metric telling us? Well, on the most simple level, it's telling us whether or not management is actually creating value. Tangible book value per share is essentially the value of the company's net assets per share, excluding intangible items like goodwill, trademarks, or brand value. So for BDCs, it basically represents what the investment portfolio is actually worth after subtracting out the liabilities and on a per share basis. Now, we have to remember the per share basis is key, because if we jump over to the stock screener and just look at Main Street Capital as an example, what we can see if we zoom in down here is BDCs dilute their shareholders. Now, this is actually pretty typical, and it's not necessarily a bad thing because BDCs are required by law to pay out 90% of their earnings in the form of dividends, which means really to raise capital, they either have to take on debt or issue new shares, whether or not they're creating value by growing tangible book value on a per share basis. So we can see in the case of Ares Capital Corporation, yes, they've been growing tangible book value per share. That's a good sign. But there's a lot of BDCs who are simply not doing this over different periods of time. There's a lot of BDCs that are destroying shareholder value. It's actually pretty common. It's a scary thing to see. So obviously, as we create almost our BDC investable universe, we want to look for BDCs that are growing tangible book value per share. And then finally, if you're buying BDCs, if you're buying this high yield asset, you obviously want there to be sustainable dividend payments. And this is where a lot of people start to make mistakes. And for reference, the average dividend yield of BDCs in this database is about 13.4%. But here's what people are missing. As I was building out this database, I noticed nearly every single software lists the incorrect yield for BDCs. Just look at this as an example. Main Street Capital on Seeking Alpha, the yield is showing 7.2%. But if we look at the base dividend yield for Main Street Capital in the database, here's what you'll notice. Right here we have Main Street Capital, and if we zoom in, we can see the base dividend yield right here at 5.4%. Why is there a base dividend yield and a total dividend yield? What's the difference? BDCs technically have two different yields, the base and the total. The base yield is what we should hypothetically be guaranteed to get, and anything above that is considered special dividends that essentially depends on how much extra income a BDC is generating in the moment. It's just like the image we saw just a moment ago. In the gray, we have the base dividends being paid out, and in the green, we have the special dividends being paid out. What softwares typically do is they show the total dividend yield, but this is a massive mistake, especially right now as we enter a falling rate environment, because again, dividends are paid out of the net investment income. And net investment income can fluctuate a lot if a BDC has high variable rate debt as those interest rates go lower, meaning that the dividend sustainability becomes a little more questionable, and it's very likely we'll see less in special dividends. You have to see all these metrics we're talking about are linked together, and it boils down to whether or not those dividends are sustainable. So when we talk about these dividend payments, we want to look at the base dividend coverage. How well is net investment income actually covering that base dividend? For a lot of BDCs, it's unfortunately below 100%, meaning net investment income is not covering those dividend payments. We can see there's plenty of examples of that in the BDC database. Again, it's pretty alarming. There's a lot of bad BDCs. So now that we've got a general understanding of three key metrics for BDCs, let's create our BDC investable universe to find the best opportunities and then look at their valuations. So to start, this one should be obvious. Let's say that we don't want to have any BDCs in our filter that have base dividend coverage of under 100%. We'll filter by condition, and we'll say that this number must be greater than or equal to 100%. So we started with 42 BDCs in our database, but after running that filter, we're now down to just 23. So we just weeded out a lot of BDCs that most likely don't have sustainable dividends. But there's certainly more that we need to take into account. Again, we want to make sure we're buying BDCs that are actually creating shareholder value. And again, we measure that by looking at tangible book value per share. So let's go ahead and zoom in and scroll all the way over. We have our 3, 5, and 9-year tangible book value per share. Let's just focus on the 5-year. Now again, what we're looking at here is historical data, whether or not management has grown tangible book value per share in the past. And so past performance isn't always indicative of future performance, but if we see very bad tangible book value per share growth over the last 5 years, then that probably means management isn't doing the best job. But in this instance, let's say we only want to look at BDCs that in the past have had positive tangible book value per share growth. So we're going to say we want it to be greater than or equal to 0. We'll hit OK, and all of a sudden you can see our list has been narrowed down by quite a bit. We started at 42, got lower, and now we're just at 9 after running only 2 different screens. So now we know we're looking at BDCs that at least have some sustainable dividend coverage. They're growing tangible book value per share over the last 5 years. But finally, we need to ask ourselves, how exposed are these BDCs to a declining interest rate environment? The less variable rate debt they have, the better. Now, by design, most BDCs do have significant exposure to declining rates, but let's mitigate this just a little bit. Let's say we want to look at the variable rate debt. And we want to add a condition where we only look at BDCs where that number is going to be less than or equal to at least 95%. Let's see if that clears out any BDCs. And all of a sudden, you can see we've lost a few more. After running all these different filters, our BDC database is now down to just 6 different BDCs. We have Ares Capital Corporation, Crescent Capital BDC, Fidus Investment Corp, Gladstone Capital, Main Street Capital, and MSC Income Fund. What we've been able to do is create our investable BDC universe right now based on 3 different screens for quality. Now what's interesting is every single one of these BDCs over the last 3 months has been hammered, which means that the valuation is getting better as long as they're growing tangible book value per share, which we can see historically speaking, that's exactly what they've been doing. So the last thing we should take into consideration really is the valuation. And if we come over here, we can see the price to net asset value. This essentially is telling us whether or not the BDC stock price is trading at a premium or discount to the actual value of its investment portfolio. So if this number is greater than 1, for example, like Fidus Investment Corporation, it means investors are willing to pay a little bit more than what the underlying portfolio is actually worth. Now, why would they do that? Well, the market probably trusts the management team because they've grown tangible book value per share historically speaking. It probably means that the dividend is viewed as safe. We can see this is the case for Main Street Capital as well. Main Street Capital is trading at a significant premium. Look at the price to tangible book value per share for Main Street Capital since 2018. It's very typical for them to trade at a significant premium. In fact, the only time they weren't was when we saw the crash in 2020. For most of the time, we can see their average price to tangible book value per share is about 1.63 times. Now, if we zoom in and look at just the last 3 years, we can see that valuation multiple has certainly expanded considerably, but it's come down quite a bit, especially in the last year and really especially in the last 3 months. Now, why would Main Street Capital deserve to trade at such a premium? Well, look at this. It has the highest base dividend coverage in the BDC database. It's actually seen dividend growth. We can see it has the lowest variable rate debt. It's growing tangible book value per share faster than any other BDCs. And on top of this, this is the cherry on top. Most BDCs are externally managed, but Main Street Capital is internal management. It means that management is very closely aligned with shareholders. They have stake in the game. These are the types of qualities that make investors willing to pay a higher price to net asset value. So while obviously this isn't the only valuation metric you want to look at, yes, you want to look at the history of what the valuation has looked like as well, but this is a really good place to start. And even though we filtered through all these BDCs to look at the quality, we can still see there's high yield opportunities, even if we only look at the base dividend yield and don't include the total dividend yield. I'm a firm believer that high yield investing gets a bad rap because a lot of people don't understand it. They don't know how to analyze these different investments and they don't know how to filter for quality. And this is the reason over on Dividendology.com, I'm building a real money high yield portfolio with complete transparency. We're looking to build a portfolio with an over 8% yield that doesn't destroy the net asset value. So again, be sure to check out Dividendology.com at the link in the description, or again, you can scan the QR code that I'm putting on the screen right now. So again, as this BDC sell-off continues, we need to make sure we understand and can analyze which BDCs are higher quality so we can take advantage of this sell-off. There are absolutely high yield opportunities out there if you know what to look for. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.